Question 1. A policyholder has purchased a long-term care insurance policy with a waiver of premium provision. What does the waiver of premium typically allow? A. The policyholder's premiums are waived once they qualify for Medicaid. B. The policyholder's premiums are waived once they enter a long-term care facility and begin receiving benefits. C. The policyholder's premiums are waived if they experience a lapse in coverage due to financial hardship. D. The policyholder's premiums are waived during any policy elimination period. Answer: B. Explanation: the waiver of premium provision in long-term care insurance allows the policyholder to stop paying premiums once they begin receiving benefits under the policy, typically when they enter a long-term care facility. It is important to note that this waiver only takes effect after the policyholder begins receiving benefits, and the premium waiver typically continues as long as the person is eligible for and receiving long-term care benefits. The provision does not relate to qualifying for Medicaid, financial hardship, or the elimination period, which is the waiting time before benefits begin. Relevant law: Florida Statute Section 627.94,072. 3. Outlines specific provisions regarding policyholder benefits and premiums, including waivers for long-term care insurance. Question 2. Scenario-based. Mrs. Thompson, the 65-year-old woman, has been diagnosed with mild cognitive impairment and is showing increasing difficulty managing her daily activities. She has a long-term care insurance policy with an elimination period of 90 days. Mrs. Thompson now requires assistance with two of her activities of daily living: adults, bathing and dressing. Her policy specifies a DL criteria for benefit triggers. How should her insurer handle her claim at this point? A. The insurer will deny the claim because mild cognitive impairment does not meet the benefit trigger for long-term care insurance. B. The insurer will approve the claim immediately because she needs help with two adults, which meets the benefit trigger. C. The insurer will approve the claim, but benefits will begin after the 90-day elimination period. D. The insurer will approve the claim only if Mrs. Thompson also needs help with a third ADL. Answer: C. Explanation. Under most long-term care insurance policies, needing assistance with two or more ADLS, such as bathing and dressing, triggers eligibility for benefits. Mrs. Thompson meets this trigger since she needs help with two adults. However, since her policy has a 90-day elimination period, she will need to wait for that period to pass before benefits start. Cognitive impairment alone may not trigger benefits unless it impairs daily activities or safety, but in her case, the ADL criteria apply. Relevant law: Florida Statute Section 627.9404 defines ADL criteria and elimination periods in long-term care insurance policies. Question 3. Which of the following factors is most likely to affect the premium costs for a long-term care insurance policy? A. The amount of the policyholder's monthly income. B. The policyholder's health status at the time of application. C. The policyholder's current long-term care needs. D. The type of care provider the policyholder selects. Answer: B. Explanation. The policyholder's health status at the time of application is a key factor in determining the cost of premiums for long-term care insurance. Healthier individuals typically receive low premiums, while those with pre-existing conditions or higher health risks may face higher premiums or even denial of coverage. Income or current care needs are generally not factors in determining premiums, or rather, premiums are set based on underwriting considerations at the time of policy issuance. The type of care provider impacts the benefits paid out, but not the premium costs. Relevant law: Florida Statute Section 627.9407 addresses the factors insurers may consider when setting long-term care insurance premiums, with health being a primary factor. Question 4. Which of the following describes the primary difference between tax-qualified and non-tax-qualified long-term care insurance policies? A. Tax-qualified policies offer more benefits than non-tax-qualified policies. B. Tax-qualified policies are more expensive than non-tax-qualified policies. C. Benefits from tax-qualified policies are generally tax-free, while benefits from non-tax-qualified policies may be taxable. D. Only non-tax-qualified policies are required to meet federal standards for benefit triggers. Answer: C. Explanation. The main difference between tax-qualified and non-tax-qualified long-term care insurance policies is the tax treatment of benefits. Benefits from tax-qualified policies are generally tax-free if the policy meets IRS requirements. Non-tax-qualified policies may provide benefits that could be subject to taxation depending on the circumstances. Tax-qualified policies must meet federal standards for benefit triggers, such as the need for assistance with 2 or more activities of daily living, adults, or a severe cognitive impairment. Relevant law. Internal Revenue Code Section 7712 governs the tax treatment of long-term care insurance, including tax-qualified policies. Question 5. What is one of the main purposes of the free look period required in Florida for long-term care insurance policies? A. To allow insurers to change the terms of the policy after it is issued. B. To allow the policyholder to cancel the policy for a full refund within a certain period after purchase. C. To permit the policyholder to adjust benefit amounts without underwriting review. D. To allow the insurer to extend the elimination period for an additional premium. Answer. B. Explanation. The free look period allows policyholders to review the terms and conditions of their long-term care insurance policy and cancel it within a specified period, typically 30 days, for a full refund if they are dissatisfied. This period is designed to protect consumers by giving them time to make sure the policy meets their needs without incurring any financial loss. Insurers cannot change the terms of the policy during this time, and it has nothing to do with adjusting benefits or elimination periods. Relevant law. Florida Statutes Section 627.9407(2) requires a free look period for long-term care insurance policies. Question 6. Scenario-based. Mr. Wilson has a long-term care insurance policy that includes an inflation protection rider. After purchasing the policy at age 55, Mr. Wilson has consistently paid premiums, and now, at age 65, he is preparing to retire. The policy provides for 5% compound inflation protection. If Mr. Wilson originally had a daily benefit of $150, what would his daily benefit amount be now? A. $192.50. B. $187.50. C. $244.91. D. $232.05. Answer. C. Explanation. The compound inflation protection rider increases the policy's daily benefit each year by a certain percentage of the current benefit amount. In this case, the benefit increases by 5% annually compounded. Over 10 years, the formula for the increased daily benefit is calculated as follows. New daily benefit 150 x 1.510 square equals 244.90 on. This ensures that Mr. Wilson's daily benefit keeps up with the rising cost of care. Compound inflation protection provides a more significant increase over time compared to simple inflation protection, which earns a fixed amount each year. Relevant law. Florida Statutes Section 627.94,072(5) requires insurers to offer inflation protection options for long-term care policies. Question 7. What is the primary purpose of the waiver of premium rider in long-term care insurance policies? A. To suspend premium payments when the policyholder is receiving long-term care benefits. B. To refund premiums paid if the policyholder does not file a claim within a certain period. C. To allow the policyholder to stop paying premiums after they turn 65. D. To reduce the premium amount as the policyholder's age increases. Answer A. Explanation. The waiver of premium rider allows the policyholder to stop making premium payments while they are receiving long-term care benefits under their policy. This rider is an important feature because it relieves the policyholder of the financial burden of continuing to pay premiums during a time when they may already be incurring significant costs for care. The waiver typically remains in effect as long as the insured is receiving benefits. Relevant law. Florida Statute Section 627.94,072(3) outlines waiver of premium provisions for long-term care insurance policies. Question 8. Which of the following factors is most likely to disqualify an applicant from receiving long-term care insurance coverage during the underwriting process? A. The applicant's age. B. The applicant's current income level. C. The applicant's pre-existing medical conditions. D. The applicant's history of filing insurance claims. Answer. C. Explanation. Pre-existing medical conditions are a significant factor in the underwriting process for long-term care insurance. Insurers often deny coverage or charge high premiums to applicants with certain health conditions that indicate a higher risk of needing long-term care. While age can affect premiums, it typically doesn't result in disqualification on its own. Income level is not a major factor in underwriting, and past claim history with other types of insurance is usually not considered during long-term care underwriting. Relevant law. Florida Statute Section 627.9407 2 details factors affecting eligibility and underwriting for long-term care insurance. Question 9. Which of the following statements accurately reflects the Medicaid Estate Recovery Program in Florida? A. Medicaid may recover funds from the estate of any long-term care insurance policyholder. B. Medicaid can recover the cost of long-term care services paid on behalf of a Medicaid beneficiary from their estate after they pass away. C. Medicaid can only recover funds if the policyholder had less than $100,000 in assets at the time of death. D. Medicaid cannot recover funds from the estate if the policyholder is receiving only home health care services. Answer. B. Explanation. Under the Medicaid Estate Recovery Program, Medicaid can seek reimbursement from the estate of a deceased beneficiary for the costs of long-term care services that were paid on their behalf. This applies to beneficiaries who received Medicaid-funded nursing home care, home health care, or other long-term care services. Medicaid recovery is limited to specific circumstances and is subject to certain exceptions, such as if the deceased has a surviving spouse or dependent children. Relevant law. Florida Statute Section 409.9101 governs Medicaid estate recovery in the state of Florida. Question 10. Which of the following benefits is typically not covered by traditional long-term care insurance policies? A. Nursing home care. B. Assisted living facility care. C. Respite care. D. Cosmetic surgery after an accident. Answer. D. Explanation. Cosmetic surgery is generally not covered by traditional long-term care insurance policies, as these policies are designed to provide coverage for services related to long-term care needs, such as assistance with ADLS and medical care required due to aging, illness, or injury. Covered services typically include nursing home care, assisted living facility care, and respite care, which is temporary care provided to give family caregivers a break. Relevant law. Florida Statute Section 627.9404 defines covered services under long-term care insurance policies. Question 11. Which of the following is a common feature of long-term care insurance policies that helps to ensure coverage remains adequate over time? A. Guaranteed renewability. B. Waiver of premium. C. Inflation protection. D. Preferred provider network. Answer. C. Explanation. Inflation protection is a common feature in long-term care insurance policies that allows for the daily benefit amounts to increase over time, keeping pace with rising healthcare costs. This feature helps ensure that the policyholder's benefits remain sufficient to cover potential future long-term care expenses. Guaranteed renewability ensures that the policy cannot be cancelled due to age or health changes, but it does not address inflation. Question 12. In Florida, what is the maximum period for which long-term care insurance policies may provide coverage? A. 1 year. B. 5 years. C. 10 years. D. Lifetime. Answer. D. Explanation. Long-term care insurance policies in Florida can provide coverage for a lifetime depending on the terms of the policy. Policies can also be designed to cover specific durations, such as 1, 2, 5, or 10 years, but lifetime coverage is available and is a significant consideration for many policyholders. Relevant law. Florida Statutes Section 627.9407 2 discusses the duration of long-term care policies. Question 13. Scenario-based. MS Davis has been diagnosed with Alzheimer's disease and is seeking long-term care. She has a policy that covers custodial care and skilled nursing care. What type of care is likely to be covered under her policy? A. Care provided by family members. B. Custodial care in a nursing home. C. Adult day care services. D. Experimental treatments for Alzheimer's. Answer. B. Explanation. MS Davis's policy covers custodial care and skilled nursing care, which would include care provided in a nursing home setting. Custodial care typically involves assistance with daily activities, while skilled nursing care involves medical services provided by licensed professionals. Care provided by family members is usually not covered, and experimental treatments are not typically included in standard long-term care insurance. Question 14. What is the purpose of an elimination period in a long-term care insurance policy? A. It establishes the total amount of benefits available. B. It determines how long benefits will last. C. It is the waiting period before benefits become payable after a claim is filed. D. It reduces the premium cost for policyholders. Answer. C. Explanation. The elimination period is the waiting period that must pass after a policyholder is eligible for benefits before payments begin. This period can vary in length, e.g. 30, 60, or 90 days, and is important in determining when the policyholder will start receiving financial assistance. It does not affect the total benefit amount or the duration of benefits. Question 15. Which of the following best describes the activities of daily living adults in the context of long-term care insurance? A. Physical exercise is required for healthy living. B. Routine medical assessments and checkups. C. Basic self-care tasks necessary for daily functioning. D. Social activities designed to improve mental health. Answer. C. Explanation. Activities of daily living adults refer to basic self-care tasks necessary for daily functioning, including bathing, dressing, eating, toileting, transferring, moving from one place to another, and continence. The inability to perform a specified number of DLS typically triggers benefits under long-term care insurance policy. Question 16. Which type of long-term care insurance policy is designed to cover costs for care received at home? A. Nursing home insurance. B. Home health care insurance. C. Comprehensive long-term care insurance. D. Skilled nursing facility insurance. Answer. B. Explanation. Home health care insurance is specifically designed to cover costs associated with receiving care at home, including services from nurses, home health aides, and therapists. This type of coverage can help policyholders manage their long-term care needs while remaining in a familiar environment. Question 17. When an insured individual enters a nursing home, what typically happens to their long-term care insurance premiums? A. Premiums are automatically cancelled. B. Premiums may be waived during the stay in the facility. C. Premiums increase significantly. D. Premiums are deferred until discharge. Answer. B. Explanation. Most long-term care insurance policies include a waiver of premium rider, which allows policyholders to stop paying premiums while they are receiving benefits for care in a nursing home or similar facility. This feature alleviates the financial burden during a time when policyholders are often incurring high care costs. Question 18. Which of the following statements about tax benefits related to long-term care insurance is true? A. Premiums paid for long-term care insurance are never tax deductible. B. Long-term care benefits received are always taxable income. C. Premiums may be deductible as medical expenses if they exceed a certain percentage of adjusted gross income. D. There are no tax benefits associated with long-term care insurance. Answer. C. Explanation. Premiums paid for long-term care insurance may be deductible as medical expenses on federal tax returns if they exceed a specified percentage of the policyholder's adjusted gross income (OGI). Additionally, benefits received from tax-qualified long-term care policies are generally tax-free. However, there are limits on how much can be deducted based on the age of the insured. Question 19. Which of the following is not a characteristic of a tax-qualified long-term care insurance policy? A. The policy must provide coverage for at least 12 months. B. Benefits must be paid on a per diem basis. C. The insured must be unable to perform 2 or more adults. D. Premiums may be tax deductible as medical expenses. Answer. B. Explanation. While tax-qualified long-term care insurance policies must meet specific requirements, benefits do not have to be paid on a per diem basis. They can also be provided as reimbursement for actual expenses incurred as long as the policy meets IRS criteria. The other options accurately describe characteristics of tax-qualified policies. Question 20. If a policyholder is receiving long-term care services and wishes to switch to a different insurance policy, what should they consider first? A. The reputation of the new insurance company. B. The elimination period of the new policy. C. The potential loss of benefits from the original policy. D. The availability of a free look period for the new policy. Answer. C. Explanation. Before switching to a different long-term care insurance policy, the policyholder should carefully consider the potential loss of benefits from their original policy. Many policies have specific terms regarding transferring or replacing coverage that could lead to a reduction in benefits or exclusions for pre-existing conditions. It's essential to thoroughly review both policies and consult with an insurance professional if necessary. Question 21. In Florida, what is the primary purpose of the Medicaid Estate Recovery Program? A. To provide additional funding for long-term care services. B. To recover costs paid for Medicaid recipients' long-term care services after their death. C. To prevent asset transfers prior to Medicaid eligibility. D. To reduce premiums for low-income policyholders. Answer. B. Explanation. The Medicaid Estate Recovery Program is designed to recover the costs of long-term care services provided to Medicaid recipients from their estates after their death. This program applies to individuals who were 55 years old or older when they received Medicaid benefits for long-term care, which can include nursing home care and home and community-based services. Under Florida law, the recovery process involves filing a claim against the deceased estate. Question 22. Which of the following features in a long-term care insurance policy provides a way to share benefits between two policyholders? A. Inflation protection. B. Non-forfeiture benefits. C. Shared care policy. D. Waiver of premium. Answer. C. Explanation. A shared care policy allows two individuals, usually spouses, to share a single pool of benefits. If one spouse exhausts their benefits, they can draw from the other spouse's remaining benefit amount. This feature provides flexibility and can help manage long-term care needs for couples more efficiently. Question 23, scenario-based. Mr. Anderson is considering purchasing a long-term care insurance policy. He is particularly concerned about the rising costs of care and wants to ensure he has adequate coverage for future needs. Which of the following policy features should he prioritize? A. A short elimination period. B. Comprehensive benefit coverage. C. Limited inflation protection. D. Exclusion of pre-existing conditions. Answer. B. Explanation. Mr. Anderson should prioritize comprehensive benefit coverage to ensure that he has adequate financial resources to cover a wide range of long-term care services, including home health care, assisted living, and nursing home care. Comprehensive coverage typically addresses a variety of care needs, helping him prepare for the unpredictability of long-term care costs. The short elimination period is also beneficial, but without comprehensive coverage, he may still face significant out-of-pocket expenses. Question 24. What does the term waiting period refer to in the context of long-term care insurance? A. The time it takes for a policy to become effective. B. The time after a claim is filed before benefits are paid. C. The duration for which premiums are collected before benefits begin. D. The time an applicant must wait for policy approval. Answer. B. Explanation. The waiting period refers to the elimination period that must pass after a claim is filed before the insurance company begins to pay benefits. This period can vary in length and is critical for determining when the policyholder starts receiving financial assistance for their long-term care needs. Question 25. Which of the following is a requirement for a long-term care insurance policy to qualify as a tax-qualified plan under federal law? A. Coverage must include only nursing home care. B. The policy must pay benefits based on actual expenses incurred. C. The policyholder must be unable to perform at least 2 activities of daily living adults. D. The benefits must be paid on a per diem basis. Answer. C. Explanation. For a long-term care insurance policy to qualify as tax qualified, it must meet specific requirements outlined by the IRS, one of which includes the condition that the policyholder must be unable to perform at least 2 activities of daily living able or require substantial supervision due to cognitive impairment. This ensures that the policy is aligned with the intended purpose of providing financial assistance for necessary care. Question 26. What role do claim adjusters play in the long-term care insurance claims process? They sell long-term care insurance policies to clients. B. They assess the value of the policyholder's estate after death. C. They verify eligibility and determine the coverage for claims filed. D. They provide legal advice on estate planning. Answer. C. Explanation. Claim adjusters are responsible for verifying the eligibility of claims filed under long-term care insurance policies. They assess the documentation provided, such as physician statements and care facility records, to determine whether the claim meets the policy's coverage criteria. This process is essential for ensuring that benefits are paid appropriately based on the terms of the policy. Question 27. Which of the following statements best describes non-forfeiture benefits in long-term care insurance policies? A. Benefits that cannot be taken away even if the policyholder stops paying premiums. B. Provisions that allow for the return of premiums if the policy is cancelled. C. A feature that provides coverage after the policyholder's death. D. A benefit that increases with the policyholder's age. Answer A. Explanation. Non-forfeiture benefits are provisions in long-term care insurance policies that ensure policyholders do not lose their benefits if they stop paying premiums. For example, if a policyholder decides to terminate their coverage after a certain period, they may be entitled to some level of benefits or a reduced paid-up policy depending on the terms specified in their contract. Question 28. What is the primary focus of the Florida long-term care insurance regulations? A. To provide guidelines for Medicare coverage. B. To set standards for long-term care insurance products and protect consumers. C. To regulate the operations of nursing homes and assisted living facilities. D. To enforce Medicaid eligibility criteria. Answer B. Explanation. The Florida long-term care insurance regulations focus primarily on establishing standards for long-term care insurance products and protecting consumers from unfair practices. This includes ensuring that policies are transparent, provide adequate coverage, and meet specific requirements designed to safeguard the rights and interests of policyholders. Question 29. Which of the following is a common reason that long-term care insurance claims are denied? A. The insured is under the age of 60. B. The care provided is deemed non-medical. C. The policy is not tax qualified. D. The premium has not been paid in the last year. Answer B. Explanation. Long-term care insurance claims may be denied if the care provided is deemed non-medical, which means it does not meet the policy's criteria for covered services. Many policies specifically cover skilled nursing care and other medical services, while non-medical assistance, such as companionship or basic housekeeping, might not qualify for benefits. Question 30. In the context of long-term care planning, what is the primary goal of asset protection strategies? A. To increase the policyholder's wealth. B. To make an individual eligible for Medicaid while preserving assets. C. To reduce insurance premiums. D. To eliminate the need for long-term care insurance. Answer B. Explanation. The primary goal of asset protection strategies is to enable individuals to qualify for Medicaid benefits while preserving as much of their assets as possible. This often involves planning techniques such as spending down assets, establishing trusts, and strategically gifting to family members. These strategies are essential for individuals seeking to safeguard their wealth while still receiving necessary long-term care services.